These are for chapter 12, the 3 sections. So chapter 12 overall is buying and selling investments. Like I said, this is just going to be a quick run through. You don't need to write down all the titles of all the sections. So you should title the chapter buying and selling investments. So chapter 10, we talked about kind of the basics of saving and investing. And then chapter 11, we went into the different types of investment, low risk, medium risk, high risk. And now this is getting into kind of how do you actually go about buying and selling them. So no, you don't need to copy all of this down. So where do you get your investing information? There are magazines, newspapers, investor services companies, company reports. So an annual report is a company's report to its shareholders about the financial position of the company. The Securities and Exchange Commission, SEC, requires all companies that sell stock to the public to file an annual report. So remember, we talked about previously how to be listed and selling stock, they have to meet all of these certain requirements, and the different exchanges require different things. No matter where they're selling them, if they're selling stock, they have to have an annual report. So the problem, in my opinion, with magazines is, you know, they're not very often. Sometimes they might only be monthly, which some of the stuff can change since we know stocks change daily, or even throughout the day, I should say. Newspapers, you can get daily, you can get the Sunday paper, investor services and newsletters. So maybe you get an investment company and then they send you, you know, regular emails of some sort. That would be their newsletter. But the company report tells you about their stocks and their dividends, the current stock prices, and then here's the link, which, bless you, you could always Google it and find out kind of what you're looking for. But it says like their profits and losses for the year, what their prospects are. The prospectus is a legal document issued by an investment company that provides details about the securities it offers for sale. That second sentence there, it's not part of the definition, it's just where to find it. So Edgar is the database that all of the prospectuses are listed on, and it's maintained by SEC, the Security and Exchange Commission. Investing information, other sources, investment clubs, just the way some people like go to book clubs or different clubs where they get together with their friends and talk about things. There are investment clubs. So you could get with a group of people that have similar interests and kind of do similar research and share your ideas with each other. And then last but definitely not least is the internet. It's going to, in my opinion, be the best way and the quickest way. And some of these other things like the company reports is on the internet already. But you do have to be careful with everything on the internet. Make sure you are finding good information, accurate information. This is from your book. It's just some of the key figures used in comparing firms. So when you're comparing different companies, it might be something you look at. We've talked about some of these already. Current stock price, number of employees can show if the company is downsizing, if the number of employees is going up. The market capitalization, revenue, how much money they're bringing in, the net income or profit. So remember, that's where you subtract the expenses, the profit margin, the PE ratio, the price earnings ratio, and then the current ratio. So those are just some of the things, most of which we've already talked about. But when we did that stock activity a couple of weeks ago, kind of said, you know, there was just a summary of each company. What are some other things you might want to know? And these are some of the things, if you're going to invest in a company, that maybe you want to look into. Maybe you want to compare these things. Maybe you want to make a spreadsheet and compare, 5 different companies and their stocks that you're looking into and see where they fall in these categories. These are some of the bigger internet sites with investor information. No, you don't need to write them down. Maybe you've heard of some of them. Maybe when it comes time for you to invest and you kind of say like investing websites or where to begin with investings, if some of these come up, then maybe you're like, oh, I've heard of that one. Maybe I should start there. There are a lot out there that I don't even know about. And again, this is from your book. All right, so what professional advice is available, right? You can do your own research, but maybe you don't even know where to start. You can get a stockbroker, which is a licensed professional who buys and sells securities on behalf of others. So the broker, they will make commission on the items that you buy. The investments that you buy, they're going to get some money from you. So stocks, bonds, mutual funds, all of those things that you can get through your stockbroker, they can make a commission off of them. There are 2 different types of stockbrokers. There's a full service broker and a discount broker. So a full service broker is a qualified stockbroker who provides advice about what securities to buy and sell. Maybe you've heard of some of these firms. You don't need to write them down, but Edward Jones, there's one on First Street, Merrill Lynch, Morgan Stanley. Those are all full service stockbrokers. So brokers, I already mentioned this, charge a commission for their services and products sold. They're going to recommend kind of what they think is the best timing for the stock trades. If you agree with them, they will carry that out for you. You'll get regular reports about your account. You kind of just can either do it on your own or do it all through them and just get advice from them. The stockbroker can do that for you. And then a discount broker is also a qualified stockbroker, but they do it at a reduced commission, but they provide limited services to their clients. So they're not going to sit down and have these full conversations with you and not giving you all of that advice. So some include Charles Schwab, E-Trade, TD Ameritrade, and they might have online resources for you, but it's not you're sitting down and talking with somebody. Just to be clear, a discount broker has all of the same qualifications as a full service broker. So it doesn't mean one went to more school or anything like that. They just don't provide the advice, nor do they help you manage your assets. You do that on your own because of the limited services offered. And so they're going to charge you less money, not as high of a percentage. And then there's also financial planners. A CFP is certified financial planners. They've completed educational requirements and have passed a board exam. They usually get a fee for their consulting services. They may also get a commission based on the products they sell you. So you pay them a fee to go sit down and talk with them. And then if you buy something through them, you may pay them extra money through that. They have to have a minimum of 3 years in the field. They work at, so typically, when you sit down with them, you're going to give them some of your financial information, right? You're going to give them kind of your income, all of your background, as it comes to all of your finances, your assets, your liabilities, your net worth. And then financial institutions like your banks, there are personal bankers that charge a commission on the products they sell as well. So they're licensed personal bankers. So these are just some places to get professional advice. And maybe you start off with a financial planner to kind of help you get all your finances lined up. Maybe you want to start with a discount broker so you're not paying as much and want to kind of get your toes wet and see what's going on. It's everyone's comfort level. So there's lots of places, and you guys are all very comfortable with the internet and you can go there. It's just a matter also though of how much research and time you want to put in. If it's your money, you probably want to pay attention to where it's going. Maybe you don't have a lot of time to do all of the research and you want to reach out to somebody that can help you do that. So how are the financial markets structured? We've talked about some of this already when we talked about the stock market. So there's the primary market, which is the financial market in which new issues of securities are sold. So if there's an IPO, initial public offering, when it's first offered to the public to sell, that's on the primary market. So IPOs are done by small companies seeking money to grow their business. It's the first time they're putting that stock up for sale. I think it was 2 weeks ago, maybe, that we looked at like the 100 most recent IPOs. And that's, again, the first time their stock went public. And then the secondary market is a financial market in which previously issued securities are bought and sold. The buyer is trading with an investor who already owns the stock. So the primary market, you're buying it directly from the company. It's the first time they're going public. And then the secondary market is somebody else already bought it and you're buying it from them. The security exchanges, again, so it's a marketplace where brokers buy and sell securities for their clients. We've already talked about this. The New York Stock Exchange is the largest, and it is an auction market. So a market in which buyers enter competitive bids and sellers enter competitive offers at the same time. So you want to get it for the lowest price and the seller wants to sell it for the highest price. We've also talked about the over-the-counter market, which is a network of brokers who buy and sell securities that are not listed on the security exchange. Remember, they might not meet the listing requirements. NASDAQ and the New York Stock Exchange both have some strict listing requirements. And so if they don't meet those, they can do just an over-the-counter market. So there's also direct investing, which is buying securities directly from a corporation or from the government, like when you buy U.S. savings bonds. So this will help you save money as you avoid commissions and fees. The next slide, I'll come back to the reinvesting though. This is a direct investing record. So you can see, you don't need to copy this down. It's just the example from your book. But if you are direct investing, doing it yourself without a broker, you're going to want to pay attention and keep good financial records. So you can see here, they bought 500 shares, and then about 4 months later bought another 100 shares. It went up about $3, or they sold some. It's hard to follow, but you're going to want to keep track of what you're doing. Reinvesting, so if you forego your cash dividend to receive more shares of stock, that's a form of reinvesting. It's kind of how you get more wealth.
See the stock reinvesting.
Sorry, I don't know why that happened. So if you don't take those cash dividends, you reinvest them or you turn them into stock, you're going to hopefully have more wealth because it will continue growing. A stock dividend is a dividend paid in the form of new shares of stock. So example, with a 10% stock dividend, you get 10 new shares for every 100 shares you own. So instead of the company giving you cash, they'll say, hey, here's some more shares of our stock. And if the price of the shares of the stock is going up and you sell them, you can make more of a profit. A stock split is the issuance of more stock to current stakeholders in some proportion to the stocks they already own. So, for example, a 2-for-1 stock split would give you twice as many shares for half the price each. So how are stocks bought and sold? So you open up your account. That's just like opening a checking account. You're going to need your money to put in that account. You will need some sort of ID. Potentially, if you're going in person, you may just set up your username and password online. And then there are, to place transactions, there are 4 types. There's a market order, a limit order, a stop order, and a discretionary order. So a market order is a request to buy or sell a stock at a current market price. A limit order is a request to buy or sell stock at a specific price. So for example, you could say, I want to sell this stock when it hits $40, right? Maybe you're scared it's going to drop, and so you want to hit that limit order in there. A stop order is a request to sell a stock when it reaches a certain price. Oh, maybe I said that one backwards then. Yeah, so limit order at the specific price. Stop order, you want to sell it when it reaches a certain price. So maybe you buy stock at $25 a share, it's up to $28, but you tell your broker, hey, if it goes back down to 25, sell it before I lose money. You would just break even. And a discretionary order is an order to buy or sell a stock that allows a broker to get the best possible price. So you're leaving that up to your stockbroker. You're saying with this discretionary order, hey, use your discretion. What do you think is best? Do you think it's at its lowest price and I should buy now? Do you think it's going to continue rising and I should wait to sell? And that is then up to your broker. So you can use cash, you can use credit. So using credit though to buy or sell stock is very risky. So if you don't have enough cash to make the purchase, you can use what's called leverage or borrow the money. And so using cash, that's just money you have in your account. Using credit, money you don't have there. So selling short is selling stock that has been borrowed from a broker and replacing it at a later date. It's very risky because your losses are unlimited, as a stock price could go up indefinitely. So you're selling stock that has been borrowed from a broker and replacing it at a later date. So you're hoping to buy back the stock at a lower price than you sold it for. So you sell some stock, maybe for $50, and then you're hoping to buy it back later for $40. And so then you make a profit. So you borrow that from your broker. But if the price of the stock never goes back down, then you still have to replace those stocks. Buying on margin, is borrowing money from your broker to buy stock. Also very risky, because if the stock price of stock falls, it will trigger a margin call from the broker, meaning you must put up additional cash or collateral on the loan to avoid defaulting on it. So you borrow money from your broker because you think it's going to go up. And so your idea is you will then sell these stocks later on and make a profit and you will pay them back. But if the price of that stock goes down, they may say, hey, we need our money now, before kind of you don't have any money left. So you're hoping that the price, when you buy on margin, that the price is going to go up. When you're selling short, you're hoping that the price is going to go down. So this example here is buying on margin. So Marco invests $5,000. So he has $5,000 on his own, and he borrows $5,000 from his brokerage firm with an interest rate of 5%. So now he has $10,000. So he buys 500 shares at $20 per share. And the stock is the collateral, right? So required by the Fed, if they can take the stock back from him if he defaults. So he has $10,000 and he's buying 500 shares for $10,000. 6 months later, it's now $30 per share. He sells it. So 500 shares times $30 is $15,000. He also pays commissions and fees of $150. So from his proceeds, so he has $14,850 because he paid the $150 fee. He gives the bank back, or his broker, the $5,000 plus $125 interest, since it was 5%. So now if he subtracts the 500 he put in, he made a profit of $4,725. Note there at the bottom, there's no guarantee the stock price will rise. If the stock price drops, he still has to pay interest on the loan and wait to sell the stock. If he sells it when the price is dropped, he loses money. So if you're buying on margin, you're hoping the price goes up. If it doesn't go up, you either wait for it to go up, never knowing if it will, or you sell it for a lower price and then you lose money. There's a few different buying patterns. There's buying and holding, which is a plan to purchase and keep stock for the long term. So you don't try to sell it as soon as there's a little dip or something like that. So buying and holding, maybe you're going to get cash dividends over the years. Maybe it's a long-term goal to get capital gains. Stock turning is a strategy of making regular and systematic changes in stock ownership based on trends in the economy. So you do that somewhat regularly. You know, maybe it's monthly. And you can say, like, you know, maybe oil prices are going up, things like that. Watch and wait is you will select securities and prepare a comparative analysis periodically, usually every 2 to 3 years. So you're kind of watching what has gone on before you kind of dig in. And so if maybe you don't have the money to invest right now, this isn't a bad idea that you start kind of watching some things that you know you might be interested in, so that when you can invest, you know where you want to go. So managing cost. So there you can buy round lots or odd lots. Round lots are exactly 100 shares or multiples of 100 shares, like 500 shares. An odd lot would be less than 100 shares of stocks. So you usually have higher fees if you buy in odd lots. Stocks are traded in both round and odd lots, but round lots have less fees typically associated with them. So you can save some of your fees by buying in round lots if you can afford 100 shares of a stock. Another way to manage costs is using the discount brokers. Again, we already talked about that. They may charge a flat fee per transaction rather than giving you everything else. And then timing and combining is where you are making all of your trades at once rather at different times. So you try to time them so that they line up. So you save on total transaction fees. You're not selling one today and buying another one in 2 days. you could do it all at one time. And then this last few slides. So what regulatory agencies help consumers? So oversight is the supervision of activities to ensure that investors' rights are protected. That's what oversight is. The FDIC, you don't need to copy that whole paragraph down. It's not that long, but it is. So that was established in 1933 after the Great Depression 1929 crash. That's who they insure your accounts up to $250,000. They monitor bank practices, ensure that they're lawful and ethical. So FDIC, you've probably heard that term, hopefully lots of times. They're the ones that back the banks because of the crash in 1929. The SEC, they are the primary overseer of the securities market. Their goal is to protect investors, and they're the one that enforces security laws like insider trading or accounting fraud. Those are some of the things that have come up in the last, I don't know, those are bigger company scandals that came out in the last 10, 20 years. But the SEC, again, their main goal is to protect investors. They oversee the securities market. That's what you really need to get from that. And then there are some reform laws. There are quite a few in your book. I did not include them all here. So the Dodd-Frank Wall Street Reform, also just known as the Wall Street Reform Act, that was a law that seeks to decrease the risks in the U.S. financial system and enhance investor and consumer protection throughout the system. I don't need you to know the name of that law. I don't need you to even write that in your notes. You can. But the idea is the two that are in bold are kind of what I thought were the biggest ones. With this Reform Act is credit scores. You get one free credit report a year from each of the 3 credit bureaus. So there's the 3 main credit bureaus. You can reach out to all of them once a year and get a free credit report. I recommend doing it, staying on top of your credit, making sure nothing is on there. They did some other stuff. Liar's loans are prohibited. What that is, the banks must verify and document your salary info before giving you a mortgage loan. So back in the housing, when the housing market had their big crash back in, I think, like 2008 time, they were giving people liar's loans. What that is, they would say, oh yeah, I make $100,000 a year. And they're like, oh, well, great. Then you could get a loan for $700,000. But they wouldn't make them actually show any kind of statement saying that's how much money they actually made. So those are no longer allowed because of that housing collapse. They now must verify all of that. Credit rating monitoring, new oversight, increased insurance supervision. So again, the idea of just putting this out there is to know that there are reforms and laws out there that have your back and protect you. I don't expect you to necessarily remember every single one, but you can look into them. And if you're ever unsure, you have the internet at your fingertips to kind of look and see what's out there to protect you and what your rights are. All right, so that's it on those notes, just real quick. So we are here. Your notes for the week are done. If you just type those notes, you can turn them in with the math from yesterday, please. I would prefer it. I know they're not due until Thursday, but if you have them all done, get them in the sooner the better. It makes things easier on me. The vocab worksheet was last night homework. Tonight, your questions are right here, this chapter 12 summary review. Those are your questions for tonight. Tomorrow we will do a Kahoot, and then you will take your tests tomorrow or Friday morning. Any questions?